thanks for tuning in. Holly Shields here for kalkinemedia. Let's talk price elasticity of supply. But first, please sub to our channel, and while you're at it, press that bell icon. Price elasticity of supply is a method used in economics to measure how the supply of goods and services changes with a change in their market price. It's a method to calculate the response of one variable, the supply of goods and services, to a change in another variable price. As per the basic economic theory, an increase in the price of goods and services will also increase their supply. Contrarily, there'll be a decrease in the supply of goods when their price decreases. Numerically, the price elasticity of supply, or PES, is depicted as the percentage change in the supply of goods and services divided by the percentage change in price. Price elasticity of supply can be denoted as PES or ES. In economics, elasticity refers to the percentage change in one economic variable in response to a change in another variable. In business, elasticity indicates the degree to which the consumers change their demand for the goods and services in response to a change in their price. Overall, price elasticity calculates the change in demand or supply of goods and services in response to a change in prices. Thus, elastic indicates that a product is sensitive to any change in the price, whereas inelastic means that a product remains unaffected by the price movements. So, how does an increase in demand for goods and services affect their price in the market? Well, as we know, producers compete for gains in a free market economy. Because the profits are never the same at all times for different kinds of goods, entrepreneurs tend to shift resources and the workforce efforts towards those products that can help them earn more profits. Thus, they move away from goods and focus less on the profitable goods. This results in an increased supply of highly valued goods and a reduction or decrease in the supply for goods that are considered less valuable. Economists and financial analysts term the tendency price and quantity supplied as related to the law of supply. For example, let's assume that suddenly consumers start demanding more apples and fewer mangoes. Thus, there is more dollar bidding for the apples and lesser for the mangoes. This will result in an increase in apple prices and a decline in the price of mangoes. Observing this shift in the consumer's demand, the producers of fruits will decide to grow more apples and fewer mangoes, since it can increase profits. So, what are the different types of price elasticity of supply? Essentially, there are 5 kinds of price elasticity of supply, or PES. They are perfectly inelastic, relatively inelastic, unit elastic, perfectly elastic, and relatively elastic. What are the 5 determinants of price elasticity of supply? Taking the example we just looked at, the answer to the degree of increase or decrease in the supply of apples and mangoes depends on those 2 fruits' elasticity of supply. This means that the supply of apples will increase drastically if they have an extremely high price elasticity of supply. Meanwhile, on the other hand, the supply of mangoes will not decline dramatically because they might possess a lower price elasticity of demand. A number of factors can affect price elasticity. Some of them are the capacity to which industry can increase or decrease the production of a product that it already has, quantity of current stock, inventory, or raw materials that an industry owns, and the time taken by an industry to produce a product, and the workforce and funds available also impact the quantity supplied. Now that you're up to speed, check out some of our other videos to boost your financial IQ. If you like this info, please give us a like, comment, and a share. For more info, head to our website at kalkinemedia.com. This has been Holly Shields for kalkinemedia.